Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. All right, welcome to another episode of the Ideal Investor Show, where we bring you really cool guests that have really cool stuff and sometimes really cool names. Today we have Shauna, the tax goddess, with us. Shauna, welcome to the show.
Aw, thanks so much for having me. I like my name too.
Absolutely. And I haven't had any goddess on the show yet.
I'll do my best to live up to it.
That's great. Now, before we go into any kind of detailed taxations, I'm just rattling down all the kind of little abbreviations Shauna has behind her name. Tell us a little bit, how did you become the tax goddess?
Oh, I love it. So I actually started off in astrophysics, not anywhere near taxes, not even close. And this was way back when I was a baby, 19. I came home from college during the summer, and I was sitting across the table from my mother. And my mother is my goddess, right? And so she's German, very stoic, very, always controlled, knows what's happening, always has a plan. And she was sitting across the table opening mail. And, she opened this piece of mail and she kind of went, put it down on the table and pushed back from the table. And
Right.
What's going on? Are you okay? What's happening? She got a notice from the IRS and she had said, listen, I've worked with the CPA. I've worked with the tax attorney. We've tried to reduce the taxes. We've done everything we can. Nobody can seem to help me. Now, as a redhead German daughter myself, right? I'm like, well, I can help you. We're going to figure this out. And so when I went back to college, on top of my astrophysics stuff, started taking accounting, finance, tax. There's got to be a way, right? Because of course I'm smarter than the CPAs and the tax attorneys, and little bit of ego there, right? Just a hair. A very long story short, when I started working with tax, my brain fell in love, okay? Because taxes are all about taking a set of rules and applying it in fun and creative ways to be able to get to an end goal, right? And in this case, it was to reduce the tax of my mother, right? Which made me happy, made her happy, all the things. So very long story short, I fell down a rabbit hole of tax and started getting all those designations you were talking about. So CPA, Masters in Tax, CTC, CTP, CTS, Tax Goddess, you name it. And here we are now, 25 years later. And so yeah, we've saved for my mom and for all of our clients a little over 1.57 billion with an average tax rate of about 6.92 for all of our clients. So it's fun. Fell into it.
That sounds very good. And anybody in the audience who hears 6.9 or something percent in that range and is normally used to look at their 1040, they probably know that it's more than 6.9 or 16.9 or more closer to 26.9 or something. So
63 if you're living in California, it's crazy. So yeah.
Yeah, right, exactly. So, or in Germany, since you mentioned it a few times, so that's pretty amazing. That's really cool. Now, one thing before we go into anything financial related and so forth, I have to ask you, as at least there was a certain love to astrophysics. Did you see the first spacewalk last night?
I did. It was so cool. I think it's one of those things where I still, I have a telescope. I go out. I live in the desert in Arizona, right? So I go out in the middle of the desert. You get to see all the things. But it's nice to have two passions from that standpoint, right? The fun passion I get to do for fun, and the passion I get to do that saves everybody money except for the IRS, which I'm fine with. So
yeah, absolutely. And I like actually, in this from an evolution, maybe I have to add one more level going forward, but I really like the perspective of aiming to reach mastery. And, maybe then the next level after that is goddess status or something like that after mastery, but
we'll have to rewrite all the textbooks. It's fine.
But see, why I'm saying this is, obviously, I was not at the time somebody who could have run the software company any better than when he was the founder, but I knew my area was training and customer service. Somebody else was for marketing and sales and so forth. And that's actually your point. And I think it's very valid for anybody who might be a business owner out there, that you bring in people when you reach a certain, even if it's a relatively small scale, of people with a specific expertise. And not to say you're not smart enough, but it's also a capacity thing, right? And if these different
100%.
people with different expertise have a certain level of mastery in their areas, it is just, in a way, to look at this from a mastery lens. I'm sure these letters all mean something behind your name that show this evolution towards mastery in a certain topic. Which brings me to the question, in the little set of things that your team said we might want to talk about. Obviously, our show is about real estate investing. Yes, we talk about 1031 exchanges and stuff like that. But maybe you have a few things for somebody who is in the process of building a residential portfolio where you would say, hey, let's look at a few things that you should be aware of to do, so that maybe not 6.9%, but maybe like in 10, between 10 and 15% or something like that.
But let's see. We're going to fight for 6.9 too, and we're going to see what we can get. Yeah, I think when we start talking tax, specifically for real estate, okay, now I always come at every business because real estate is a business. And if you're not treating it like a business, you are missing out on some of the amazing things that you can do from a tax perspective. So I always come at it from two angles, right? There are specific things that are real estate only, okay? And I presume, because this specifically for real estate, the basics. You mentioned 1031, real estate professional status, active, if you're married, if one person has a W-2 and the other one can get real estate professional or active, right? That those combinations, especially adding on top something like cost segregation, those state specific things can really blow up your ability, more cash flow, because you're not paying whatever profits to the government. You get to keep that cash and reinvest it in more properties or diversify, depending on what your goals are, right? If you're already at 100-door portfolio, you may not want to get more than 100 doors. You might want to start looking into, if that's SFRs, right? You may want to go look at single family residence. You may want to go look at commercial, or go look at cold storage. It's still real estate related, but in different areas and industries within real estate. I think that's one of the biggest pieces that we saw failures in 2008. And, we're starting to see the failures here again. Everybody tend to chase the dollar. So we get this huge boom in Airbnbs. Well, then something like COVID hits and nobody can pay their bills, right? So diversification, and I know that's not necessarily a tax specific topic, but being able to stand back and look at the business of real estate rather than just, okay, I'm way deep into the weeds on whatever it is. And then secondly, the other side of it that I feel so many people miss is the actual business side of it. So are you hosting events? Should you be using the master's exemption? Are your kids being used as models in photo shoots in the front of your single family residence to show like, hey, come rent this cool house? Are you writing off your security dogs? Okay, I have 3 of them. I have a German Shepherd, a Cane Corso, and basically a mutt, a very protective mutt. And so if you're not writing off your security dogs, right, should you be? I always like to come at it from the big perspective first. When we look at tax strategy, we tend to look at where are you spending your money, right? So are you spending it on dogs? Are you spending it on kids? Are you going on travel? This is a big one for real estate folks, right? As you travel, the benefits of real estate, you can look at real estate anywhere on the globe, pretty much, except maybe the Sahara Desert or whatever, right? There's real estate and there's something to buy. And so if you're looking at like actually investing and you're really making an effort, attempting to make a profit, that's a big piece for the IRS. If you're trying to lose money, they don't like that very much. So you've got to try to be making a profit, but that allows you to write off 1,000,001 things.
Yeah, absolutely. And you're right, and not just to call it or treat it like a business, but really turn it into a business. In our case, mainly in residential real estate from turnkey providers, because one of the things that people actually are interested in our particular model is that if you really look at it as a business, when you ask yourself in a business, who would be the different departments occupy or basically get occupied? Well, in a real estate business, you need property management. So that's a department for which you hire. You need lending, that's a department. You need insurance, that's a department. You need all these different things, banking and what have you.
It's our team of professionals. Without your team of professionals, you're cooked.
The only point is that they're not really W-2 employees, but everything else from our discussion is basically the operations company, and then underneath in the series structure, as I'm sure you're very familiar, is where the assets are actually kept and separated from each other so that we're not a target for
100%.
lawsuits and stuff. Now, One of the things that people are, if they don't want a 1031 exchange, or it's not really a suitable thing,
Yeah.
but if anybody who bought something, let's say since about 2018 or so, you
Yeah.
have probably something like anywhere between 40, 60, even more percent in gains.
Yeah.
What would you, from your perspective, if a client came to you and say, okay, Axel or somebody else helped me to set up the series structure, I separated my private stuff from the business stuff, I have a corporate veil set up, all that, but now I want to sell this property and I want to avoid that I have to pay a lot, but I don't see a good opportunity for an exchange. Like, if you have a,
100%.
let's say 4% interest rate mortgage and you want to exchange, you still probably need a loan and it might just not pencil out, right? So what is there other than knowing, okay, capital gains tax is not regular income, but it's still not anywhere close to like our goal of 6.9.
Wow.
Are there
Yeah, it's still lower, but it's still 20%, right? Depending on how
right,
much you sell.
depend,
So
maybe 15 if you're lucky,
maybe if you do good planning, 2015 0. What we're aiming for is 0. When we come at any kind of sale, okay, so it could be you're selling one property, it could be you're selling your entire portfolio, right? There's a lot of people that like, I'm done just being in the business completely. I want to sit back and just live on interest, whatever it is. The main questions we have to ask, okay, number one, has the transaction already happened? As you know, with 1031, you have a certain number of days, right, to go find a replacement property. Okay. So you could always, as a short-term deferral tactic, okay, you could put everything into escrow to maybe find something. But what happens if it doesn't work? As you said, I can't find a replacement. There's no good deals. Nothing's penciling out. If the transaction has already happened, right, there are certain other strategies besides 1031 that come off the table. So things like an installment trust, an installment sales trust. There's about 16 different versions of charitable something trust. Okay, always typically one or two letters in between. These types of strategies come off the table if the transaction has already happened. So step one, has the transaction happened? If it has not, you're probably looking at about 20 different strategies to either defer or get out of paying tax completely on the sale. If it's happened, that number gets cut down to about 10, right? So step one, has the transaction already occurred? If the transaction has occurred, right, now you're looking at what other strategies and where do you want the money to go? If you sell this $1 million property, like you're going to net out $1 million worth of cash on this property, what are your plans for the money? Does the wife want to remodel the kitchen? Well, there's 200,000 right there. If it goes to a personal property, you're going to pay tax on it. Period, right? If you're doing personal things with it, you're going to pay tax. If you're going to put it in the stock market, there are things we can do for that, right? If you're interested in oil and gas, solar, tribal credits, if you are interested in charity, there are some of the charitable trusts that can be done after the sale, which is okay. You could consider setting up a private foundation or donor advised fund. There are lots of options from that standpoint. So really the big question is, well, what do you want to do with the money? If you need to use it for personal, you're going to pay tax. If you're okay to invest it, then typically you either get a deferral or you get a complete no tax for hundreds of years in many cases, right? It can defer after generation after generation after generation.
In a sense that 1031 is a form of deferral as well, if you think
100%. Yeah. And 1031, I mean, the hard part with 1031 is exactly what you said, right? If I don't find another piece of real estate that I like, there's nothing.
Yeah, I think it's very valuable, and thank you for being here and explaining this to the audience, that you don't have to automatically assume that you can only exchange into real estate. Right? If I were to translate what I heard you just say, I would translate it to say you can exchange, if you purely look at the dollars, forget that there was a house that actually represented the dollars. So now this house was basically turned into dollars, dollar bills or number on your bank account. Then you exchange that amount of money into all these different things potentially that you mentioned. You said it goes down from like almost 30 options to maybe 10 or less if the transaction already happened. To what extent is it dependent on, let's assume it hasn't happened yet, what kind of a type of real estate it is to determine which one of these other 27 options might be a good one?
No, not really. I like the way you phrased it, right? Once we know that a sale is going to happen, the tax code looks at the dollars. not necessarily that it was residential versus commercial versus raw land, right? Like, I mean, it really doesn't matter.
More at the profit, right? In a
More
way,
at
if
the profit.
if
Yeah. How much is the debt? What's the gross sales price? So with some of the strategies, it's based on the gross sales price, whether you have debt or not. The way that I like to look at any kind of sale is, again, going back to the basics, right? Has it already happened? And what do you want to do with the money? Because if you want to go spend it, if you want to buy a yacht, okay, there's a couple of things that'll work. Not all the things will work, right? So those are the two key questions for me to determine which path we start to go. Also, who else do we have to play with? Because if your spouse, like if you're married, we might be able to do something with the spouse. If you have kids, we might look at transferring something into a family limited partnership to spread the tax rates. It's also kind of dependent on who else is a part of the tax game that we're playing.
Absolutely. And I think that's an important thing, not just in that particular case where somebody is determining, okay, do I want to sell, or coming to you after they already sold and then want to find out what can be done. I have 2 points based on that. My question went more in the direction I have seen, like if I go back to look at my transition for my own portfolio, admittedly at the time it was smaller, from all being in my name because I didn't know any better, into the series structure, and then ultimately we wanted to be absolutely 200% sure that we don't invoke the call clause for transfer of ownership. So we basically put the property deeds into the land trust, and then let the land trust be owned by an LLC, which is then owned by an S corp, just structurally to do all of that. But what I learned in this context is that yes, a structure and a set of rules is one thing, but depending on exactly what you want to do, setting it up and getting it ready and having it all basically arranged in the right way can, for certain things, be rather quick. And for other things, it can be rather lengthy. I give one example.
Right there.
The notification of the counties that had the original documents about me in my name owning the deed, they needed to be notified that now this land trust is holding the deed. And there is a certain form, the lawyers did all of that, but they basically told me we can't really go and take the land trust to be owned by something until we know that the deed has actually been transferred. And in some cases, I kept asking every like 30, 40 days, hey, how far is it? And I think the last one took almost 9 months until that particular county, whatever agency, acknowledged in writing that they had done this transfer. And, that's how long. And that's what I meant, right? If somebody says, okay, I feel like, or whatever the reason is, don't have to give a reason, but they have a reason why they want to sell something. And you clearly made a distinction between let's strategize before the sale versus after the sale. I'm kind of curious how much in advance, if you have the luxury, would you recommend for somebody to say, let's talk about what are the options if we have
Oh,
a
geez.
significant amount of money?
Yeah, I mean, in a perfect world, you want to start having the conversations about 6 months ahead. Okay.
Okay.
And the reason why we need that bit of time, right? So governments you're not going to control. They're going to do whatever they're going to do. Okay. So in some cases, it may need 9 months, a year to do these things, right? Who knows that if you have a good lawyer and a good team, they should be able to at least tell you, warn you, give you a heads up, these kinds of things, right? But from a tax perspective and a sales perspective, you want at least 6 months, if you can, at least 6 months to start having the discussions with not only your CPA, your tax strategist, your lawyer, but also with, if you're going to do an investment, right? To start looking at, what do I want to do with my money? And do I like oil and gas over solar, over tribal credits? All these options. What do I like? Because, often it can take a week or two to get on the phone with somebody, have a meeting, then you need a second meeting and there's questions, right? So in my mind, 6 months is probably the ideal, right? Maybe longer. We do have clients, and I will say this, we have clients, because as you well know, and I'm sure many of your listeners out there fall into this trap, I do myself, okay? I think about something maybe 2 weeks before it's actually going to go, before something's going to happen. I'm like, oh, maybe I should have started this a little earlier than 2 weeks before I'm about to sign on the dotted line for whatever the deal is. There are strategies for the 2-week timeline. Okay. What I can tell you is that the longer you wait, the more expensive things become. Because if you give your planning team 6 months or a year to understand, I'm about to divest of a $100 million real estate portfolio, if you can give people time, they can plan, they can get rates, they can negotiate, you can figure out what we're doing, right? You can work all those things together. If you give somebody 2 weeks, you can get it done, but it might cost you $200,000 because the lawyers now have to drop everything to do whatever it is you need to do. So the longer the time, the better the planning, even if it's just kind of a quick comment a year out to your attorney, like, hey, this is coming down the pipeline. What do I need from you? What do I need from the CPA? What do I need from the strategist? So that they can start thinking about it, maybe have a meeting once a quarter, something like that, to just everybody's on the same page, and then increase the frequency as you're getting within that 3 to 4 month timeline of the actual sale. So
Yeah, that makes a lot of sense. And especially if somebody has been able to accumulate a good sized portfolio. I mean, $100 million is a lot, and not necessarily what is needed to accomplish. In our case, what we're trying to help people, I myself do it, and our clients do it, is what we call the time freedom point, where the passive income of our investments exceeds what we need to live. And beyond that is all fine. We call that basically the cherry on the icing of the cake, and it's not forbidden that the cherry can turn into like a peach and then a watermelon and so forth, right?
that's kind of the plan. Well,
Yeah.
and there's a whole second piece to this when you talk about timelines, because often what we see when people start to build these larger real estate portfolios, right? Now people almost transition into like empire building, right?
Yeah.
They have kids, they pass this on. They want to be able to create something that's a legacy that the kids understand, and the kids are going to add, and their kids are going to add, right? That's an entirely different level of planning, right? Because now we're looking at things like estate tax exemptions, trusts, family partnerships, and training children how to do good things instead of taking money out of the trust to buy a Ferrari and crash it every 2 weeks, right? So there's
Yeah,
also
absolutely. And
education.
this empire is maybe the ultimate term, but for estate planning and building generational wealth considerations and stuff, we include that, because I believe that is not a matter of necessarily the size of your portfolio at the current moment. It's more a matter of where do I want to go. And yes, I did a job where theoretically I could have constantly took the risk of falling out of the sky. You want to be prepared. So we always had those things like a will and a trust and all those kind of things in place. But for our clients, even if they don't have jobs like that, it is still ultimately a matter of legacy, like you said, and generational wealth building. Now, coming back to a little bit more modest thinking rather than 100 million portfolio, one
That's
thing that
next year,
I have heard several times, government established this idea of an accredited investor.
right?
Now, if you're not in that accredited investor level yet, that doesn't mean, I mean, if you think about it, $1 million in assets without your residence is a pretty good number, but you could have 5 or 6 houses. Now I go to the goddess and she charges me $15,000 to save $10,000. That obviously is not necessarily an awesome deal. So back to the core question, when would you say do the numbers actually make sense to have this whole support team, or where is there some sort of a threshold where the
100%.
effort and cost than the benefit?
So you're right. There's absolutely kind of these like levels. The one thing that I absolutely believe, hands down, period, plain simple, any business owner, real estate, and anything, you need to have a CPA. That is the first level. It doesn't matter whether you have one rental property or you have 100 rental properties, doesn't make any difference whatsoever. You need a CPA who knows your industry, who knows real estate. Okay. And the question that I always tell people that ask me, right? Ask that CPA. If that CPA, you're interviewing CPAs, and that CPA says, oh yeah, I'm a real estate expert, no problem. I want you to ask them 2 questions. The first one is, explain cost segregation to me.
Okay.
If they go completely blank, you walk out of that office because they know nothing about real estate, right? Like that should be a baby basic, easy question for a real estate expert
That's actually
CPA.
surprising that is already throwing them off. Okay, cool.
It
The
throws
other
them,
one?
right. And that's what I'm saying, right? Because
Yeah.
people will say all sorts of things, but if they can't explain cost seg, walk away. Okay. And the second one is have them explain the difference between the three levels of real estate. So real estate professional, active, and passive. And if they can't answer those two questions without going, I need to research that and get back to you, you go find somebody else. Okay. Because they are not real estate CPAs. So, and everybody, you have one rental property, you find a CPA that does real estate, that knows real estate, that can answer those questions like that for you. When you start to get to above that, we start looking at almost two different paths. Okay. At the moment, the estate and trust exemption is about, let's call it 13 million per person. Okay. The number increases and it always changing, but let's call it 13 million a person. Depending on what happens in politics, and I'm not going to go into politics, okay, that number could go down, it could go up, it could stay the same, whatever it is. So if you have children, if you have a net worth of more than 250,000, which is actually a really small number, okay, or you're increasing anywhere near the 13 million number, okay, having a trust and estate attorney, if you're at the lower end, if you're at the 250 of net worth, you need a guy that you can talk to once a year. If you're getting closer, if you're in the middle, if you're 6 million, you probably want to talk twice a year, right? Just what's going on, estate trust, maybe a corporate attorney. As you get closer to that 13, you should be talking at least once a quarter, right? So kind of a timeline on that side.
Or they come up with a new form for your company that you suddenly, like my attorney contacted me and said, it's not really required, but I think you should have it. Like, do you want us to do it? I said, okay, how much is it? And it wasn't that
File the
great.
form. Well,
Yeah.
hopefully your attorneys are doing good by you, right? I mean, that's a whole other issue.
I understood when they said you don't really necessarily have to have it for the structure that you have, but it's better to be able to show you did it and you have it in your folder. And I said, I don't want to do anything. They said, oh, we can do it for you. We just needed to make you aware that this is a new requirement. But
anytime the attorney says blah, 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 but do it, it's fine. Yeah. Sorry.
One thing, by the way, since we don't have at least I don't think we have an audience of CPAs, I wanted to just say one thing real quick for those of you who listen and or watch us and say, what is she talking about segregation? So what we're basically saying is, if you think about a house, just think about for a moment a house, and you don't have it already finished. That's how I always explain it. But you were to basically have to replace everything. Like either there was a fire or you're building it brand new. You have to buy windows and stuff. And obviously every single one of those things that make the house in the end has a different time of life, so to speak. Right? Like an air conditioning system is maybe good for 15 years, depending on warranties and stuff. Tile is probably good for 30 years, but carpet, I don't know. I mean, in my experience, I would say 2.
Yeah.
2. So why is that relevant? Basically means each one of those different expenses and can segregate them individually and then spread basically the tax for the things that are 2 years long. You paid $1,000, so $500 applicable each year. If you have 10 years and you pay $10,000, it's $1,000 each year and so forth. Versus what most of us do is just to say, okay, we take the 27.5 years for the whole thing. We don't want to go through. And part of the reason is if you have a relatively small existing property, doing the standard is basically free, and doing a cost segregation study nowadays is probably in the area for a small property is probably like $3,000 or something like that.
Oh, they've come way down.
And this is why you want a goddess. If you cannot afford a goddess, you want to at least have a CPA that tells you, okay,
Yes.
how much are we going to get out of having a segregation
Do it or
versus
don't do it.
right? And if the difference is not that big, then you might as well save yourself that amount. So I just wanted to explain cost segregation basically means you look at all the items of a house and say, how much is it worth and how long is it going to last? The other thing I wanted to ask you real quick, between having a CPA and having a team, including a goddess, how would you think about some of these medium to larger size CPA firms that have basically departments? Like mine, for example, they have a dedicated real estate department that works, but the person, Brian, my guy, basically, who I know for years, he has never really claimed to be a real estate expert. But when we're not quite sure, the benefit is that they're big enough, they're nationwide, we can always check in with their real estate department. Would you say this is a middle ground, basically, if your portfolio is not that big?
Yeah. So I think goddess level is tax strategy specific. So I am a CPA. We do tax training, we do all those things, right? But that's not what people call us for. People call us for a bill of at least $100,000 minimum, and I don't want to pay it, right? Like I want to do something else. Like
Nobody
that's
would.
when nobody wants to. Yeah, why would I pay more than I have to? But that's kind of the minimum level here, right? So as you start to talk about larger CPA firms, and way earlier in today's conversation, you talked about the difference between looking at historical things versus looking at future looking things.
Right.
And to me, that's the big difference here, right? Big firms, little firms, really doesn't matter, right? You go to them after the year is finished and you say, okay, here are my numbers, do the tax return, right? Some of them do planning, some of them will meet with you in the middle of the year, and those are good. That's like your good middle firm. So yes, as you get bigger, you definitely want planning mid-year, just before the end, like November, December, just before the end of the year, those kinds of things. The typical types of planning that we hear out of those CPA offices, okay, let's buy a car, 6,000 pounds. Okay, let's do that cost seg, right? So these are what, from a strategy perspective, we look at them as the low hanging fruit, right? The baby strategies. That's what that CPA firm should be able to do for you, right? They
Right.
should be able to tell you, put your kids on payroll. Maybe not about the dogs. I haven't heard that a lot out of the middle firm, but get the kids on payroll, buy the car, set up a 401k, do the cost seg. These are good middle, baby strategies. When you've implemented all of those things and you still have $100,000 bill or more, that's when you call a strategist. So there's only 15 of us, of me, in the entire country in States, right? There are 660,000 CPAs according to Google. There are only 15 that specialize in tax strategy at that level. So once you've done all the baby strategies, and don't laugh, but for this purpose, love TikTok, because for any of you business owners, any real estate investors out there, type in tax strategies and you will get 10 million TikToks about write off the kids. Now, don't follow the strategy per TikTok. Okay, go talk to your CPA, make sure you're doing it right. Okay. But once you've implemented all of those things and you're still not happy with how much you have to pay, that's when you want goddess. That's when you want the strategist. And it's really a combination at that point on your team between your CPA, your bookkeeper, and your strategist, right? They come together to make sure that we're minimizing everything across the board.
Well, while you were explaining that, I was the Olymp would be pretty full if there were more than 15 gods, right? Like, so.
Apparently there's that new show. I haven't seen it yet, but about 15 is probably Olympus. I'm with you on that. I like it.
Okay, cool. One quick thing, and then I think we come to an end here, but what it is basically for anybody listening who has a normal job, and you please keep me straight in what I'm saying here, is basically you hire yourself in a role in your company, not just I'm the owner, I'm the CEO or whatever title you give yourself, but you literally hire yourself for a salary, and you can hire your wife and theoretically can also hire your kids. So obviously now you get paid and you get, FICA and all that social security stuff and so forth to pay. But that also means you're basically an employee in your own company, and maybe your wife is an employee in your own company, and then the company can decide how much are we matching any kind of contribution, and there is a maximum number per year that I think the IRS or somebody in the government determines what's the
It's about
maximum.
63.
So there's a maximum number per person that is in the company. I always explain it this way. If the company has, let's say, $100,000 profit, and my wife and I are employees, and this is profit after we have been paid, right? Like, so we're looking as if the year had ended, and we would predict, okay, there are $100,000 profit, then we can say, okay, the company can now decide that these two employees each get $50,000 of matching contribution into this retirement plan. Instead of $100,000 profit, it now has zero profit. When I first got introduced to it, it was called "You Will Have the Power of the Checkbook," even though we don't have a checkbook anymore. But that was basically the thing, that we can decide what we make on the other side, basically, of the fence when we're looking as the owners of this retirement plan, what is supposed to happen with the money. And so is that about fair description?
Oh yeah, absolutely. I mean, what I always warn people here is, because we hear this a lot, is, oh, I heard this, and so I'm just going to go set up my own.
Oh, no.
Nope. No, no. Yeah. This is one of the places you get an expert.
Yeah, that's
Yeah.
where we kind of come full circle, because not right at the start, but I think you and I started talking relatively at the beginning of the show today about, as an owner of the business of real estate, you establish departments, and one of the new departments at some point as you grow is the retirement department, right? And that's who you hire to help you to set that up properly, and then also remind you, like I always forget for some strange reason, that there are some filings every so often that need to be done and stuff like that.
Yeah.
So
Yeah.
okay, cool. Now I want to kind of ask you, and I hope I'm not offending you, if you could describe for our audience, who would be a right kind of person to say, hey, I listened to all of this, Shauna, the goddess, comes across as really top-notch, top 15. How and at what level does it make sense to get in touch with you?
Yeah, you don't want to use us until you have $100,000 tax bill or more. I would suggest, like you've tried some of the basic things. Now, I have seen cases where people say, listen, Shauna, I'm sitting at $80,000. I want only to work with you. Like, the stuff, you can file the tax returns, like that's fine. Right? It makes the most financial sense, right? Because we will not do things if it doesn't ROI for you. Right? Where I'm a CPA, which means I'm a fiduciary by law, right? By my licensure, I'm a fiduciary. So if it doesn't make sense for you, we will tell you this doesn't make sense. Call us next year or whatever, right? But yeah, $100,000 minimum tax from that standpoint. Or if you're really, we just have some people that just, I know I'm at the beginning. I know I'm not at that money mark yet, but I want it. You understand that means you're going to pay a little bit more, right? Then you're going to save to start, but it'll be set up. There won't be any questions. You'll know what you're doing and you'll be set up for the rest of your life. So we can see it either way. Typically, it's $100,000 in tax at least.
Right. And I think there's an important little thing. Tell me if I should or shouldn't say this, and I'm going to say it anyway, is what you just said, Shauna, is basically really an appeal for people to look at taxes not shortly before the deadline, whether it's the business deadline like 15 March or the personal one 15 April, but more to say, okay, well, it's probably a good time to start looking, where are you going to end based on what you know already and what you can kind of predict for the next 3 months coming. And then when you say, okay, what I know and what I see leaves 80, 90, 100,000 potentially out there, then to say, well, let me get in touch with Shauna and see if it's worth it or not. Because if you find out that you kind of pretend filed on March 1st, and then you want to jump in with Shauna to say, you have 10 days to tell me, is it worth it or not? So that's what I mean by that. Now, I know everybody is listening. Most of the people that know me know there is the option of an extension. So yes, I know that too.
Of course.
But fundamentally, if you look at, and I think you made that as a great point, yourself as the owner of a real estate business, you should look at it 4 times through the tax lens per year, every quarter. And as you're reaching beginning of Q4, it's a good point to say, do I need to upgrade my tax advice or not? And check it out. If they want to check it out, Shauna, how do they find a way to check it out with you?
Oh, thank you. We're super easy to find, taxgoddess.com. I do have a team, so you won't be speaking directly to me, but all my team are also gods and goddesses of Olympus, so I think we're okay. But yeah, I just a quick little addition there. The best time to start tax planning is January 1st of the year you're tax planning for. Right? The more time you have, the more options you have. So even now, right, you're calling at the end of the year, we're running out of bandwidth, right? We're running out of time. We're running out of runway, whatever you want to call it, right? Because good or bad, I have had multiple people tell me, well, Shauna, you're a goddess. Can't you just wave the magic wand and like poof, taxes disappear? I wish. It would make life a lot easier if I could do that. But unfortunately, when you talk tax strategy, you do have to actually do things. Like you talked about setting up entities, creating the S Corp, running payroll. These things are not I have 10 days until December 31st. Yep. We'll do what we can, but don't wait.
So. No, you're absolutely right. Even though I want to tell the audience, and I'm sure the goddess has a little more tricks, but my CPA has been actually able to find ways, and I'm sure you're aware of what those are, to extend the year. I think it was like even the middle of March or early April or stuff. where
Oh, yeah.
basically he said, if you do this, even though it's beyond 31st of December, if you do this now, and basically refer to blah, I didn't totally understand it, but it basically felt to me that the year suddenly got 3 or 4 months
They're
longer.
helping. 100%. Well, and I think that's really, earlier we were talking about like the number of strategies, like in a sale, right? If we look at the number of strategies just for taxes, period, our team looks at a little over 1,500 strategies. If you call us after December 31st, we can apply about 20.
Yeah, right.
If you call us before December 31st, you get 1,500, right? So yeah, there certainly are things you can do. Last minute always happens. It always happens. But it's up to you. How much money do you want to keep in your pocket? If you want more, you start earlier.
Absolutely. Yeah, I think that's good advice. With that being said, totally independent of tax returns and so forth, Shauna, if you had a time machine and you could go anywhere, where would you go?
I've always had a thing for dinosaurs. I think it's the scientist in me. So I would love to see them from a distance over there.
And I'm actually optimistic if you do that there are a few cuddly ones. They're not all like Jurassic Park, right?
Oh, that'd be amazing. I would hope so. That would be so awesome.
The other question I sometimes ask, and I know we're quite ways into the conversation, but I'm still really curious. I want to ask you that is, if you could meet anybody, who would it be and why?
It always goes back to Einstein. That's the physicist in me, right? I'd love to meet that man. That would be amazing.
Before he comes to the US or after?
I would say after.
That's good.
I feel like I'd have a little more freedom to talk to the guy.
He was pretty independent anyway. Cool. Well, Shauna, I want to really say thank you, because it's rare that we have somebody of the top 15 in their profession in the country on our show. So thanks for making the time. And like you said, taxgoddess.com is how to get in touch, right?
Yes, sir. And thank you so much for having me. This has been terribly fun. So I really appreciate it. Thank you.
Absolutely. Okay.